Welcome back to Cheddar. We do want to bring in our next guest here. Joining me now to break down the latest is Bob Iacchino, Chief Market Strategist at Path Trading Partners, and James McDonald, CEO and CIO of Hercules Investments, to break down what has been an extremely tumultuous week on Wall Street. James, let's start with you. We saw heavy volatility earlier in the week. What do the charts tell you about where we're heading?
I like the fact that we got support at Dow 20,000. Often technical analysis is imprecise because computers can't tell you what is actually going on in the world. In this case, Dow 20,000 is an important psychological level. It's the level that Donald Trump's presidency broke through. The market, if you look at when Donald Trump was elected, the market went to a new level, and breaking the $20,000 barrier, 20,000 point barrier, was a huge psychological level. So closing below that slightly earlier this week was a scary thing. I began buying at Dow 20,000. We've held there. We're holding. If we can hold Dow 20,000, I think the market looks for a bottom here and tries to go up. If we don't hold 20,000, we might go back down to pre-Donald Trump levels.
What were you buying at Dow 20,000?
It's a great question. It's important to be safe in this place. I bought VOO, a Vanguard S&P 500 fund. We got it at the bottom. We're up 4% on that position now. Obviously, when you have the market moving 7, 8, 9% in any direction, we knew that there was a huge discount that day. We came off almost 10% on the S&P, nearly unheard of. We're looking good in that position, but I will stop the position out if we come back down below Dow 20,000. But I do believe we're going to continue to hold support here, particularly as we get a grip on potential cures for this virus, potential methods where people who are sick can get better, and this thing will pass.
Okay, so Bob, I want to bring you in. What should investors expect in today's market action and heading into the weekend?
Well, we do have quadruple witching, which is just another additive volatility factor, Kristen. So we want to watch for that. I wanted to say that I'm really happy you have such a good technical analyst on the show as well, because we actually make a fundamental opinion and then we trade based on technicals if the fundamentals and the technicals line up. So technicals actually will veto a fundamental idea that I have. My technical team could veto it. But looking at today specifically, I think you want to take a little bit of the importance off of today, simply because it is a Friday and you will have speculative traders who will get out of trades prior to that weekend risk. So it may not have as much of a confirming factor as it normally does, but if you are a weekly chart watcher, which I'm sure the other guests can speak to, the Friday close matters for the weekly chart. So it actually matters on that basis, but just not closing basis.
So what do the fundamentals tell you, Bob, in terms of where we are heading longer term over the course of the next few weeks and even months in this market?
Well, if you look back to the last two bear markets, which there's been two in the last 20 years, we had one in 2002 and then we had one in 2007, 2008. And if you look at those particular bear markets, from the point we entered bear market territory, back in the early 2000s, it took about 20 months to get to the low. Okay, so that was a 20-month bear market if you started the bear market at the point where we were 20% down from the previous high. The same thing in 2008, 2009, that particular bear market, that one took 14 months to get to the low before we actually spun around. Now, one was shorter than the other, and the reason was central bank intervention. So this central bank intervention is not only greater than the last, it's concerted. It's a concerted effort amongst global central banks. So I think this will be less than 14 months to the bottom, but I think people should expect to see these rip your face off rallies that then get sold again. I don't think the low is in, but I think I agree with the other guest. You are safe. We bought about 8 stocks yesterday. We also bought silver and we bought crude oil. So we're looking at bottoms as well, but we're buying much smaller positions than we normally would.
Okay, so what were the 8 stocks that you bought yesterday?
Well, if you want, I can look down and rattle off the symbols if you want. EA, CIN, ALXN, SIVB, CORT, Intel, PRU, AMTD, and then silver and USO.
Okay, so if you're following along at home, be sure to check out those tickers. I do want to bring James back in here. Bob mentioned the quadruple witching, which happens today, which does typically provide some volatility to the market. What added volatility in this environment, James, does that add?
It adds, there's just been a recent futures rollover. It adds transition from capital, tracking one way the index is being seen to another. And that's a really, really, really good thing for our gamma yield strategy. Right now, for our aggressive growth traders, everything we're doing is capturing all the volatility premium in options. And what this does, being end of the week, being quadruple witching, and being Friday, it gives us the optimal period to harvest income that we're selling options that have this huge panic premium in them into expiration. Yesterday, we were selling contracts that had thousands of dollars of premium in them with minutes left to live expiring at zero. It's an extraordinarily lucrative strategy. And so we're taking advantage of that with quadruple riching, with Friday, and then with obviously the culmination of what's been one of the most difficult weeks. People's children are at homes, schools, buildings, offices, movie theaters, malls are closing. There's a lot more going on than the normal calendar of volatility. This is a different environment, and we're taking huge advantage of it.
Okay, so Bob, if you're at home and you're a mom and pop trader or an investor for the long term, would you be moving in and out of the market today because of the quadruple witching?
Well, that's a great question, Chris. And I think from a perspective of the mom and pop trader, they have to just stick to their strategy and shrink position sizes. That's what you want to do. When volatility widens out, you want smaller position sizes so that you have staying power. That's really the lesson I can give here to the mom and pop trader. Now, if you're more of an active investor, it's the same thing, but you do want to start, I think, at least from our perspective, scaling into things that you want to own for the sort of medium to long term. And that would be about a 2 to 5 year time horizon.
Very quickly, the biggest concern going forward, what is it? Is it stimulus and how effective that is, or is it simply the number of cases that are out there and those coming down?
I think you have to look for the flattening of that curve, and I think you have to look for the speed of the stimulus, because the two things have to happen in concert to stabilize the equity markets. You still won't get a Main Street economic stabilization from that. That's where the stimulus comes in, and that's really what we need to happen. We need them both to happen at the same time.
All right, Bob Iacchino, Chief Market Strategist at Path Trading Partners, and James McDonald, CEO and CIO of Hercules Investments. Thanks, guys.